So thank you everybody for being here bright and early. This is our first DBU of 2021.
Yay.
Yay. We're actually having once a month for the rest of this year. And our next one is going to be February 17th on financial ratios and statements. So with these seminars, our goal is to just educate and, it's just to help out the community and our clients. There's always a lot of updates at this time of year. This year is no exception with the Relief Act, so there's a lot of new provisions. So we always are looking to, you can always speak up for questions whenever you have one, just put it in the chat and we can stop Linda and I will, chime in and let her know that she has a question coming up. So thanks all for being here and I'll let Linda take it away.
Thanks, Anna. Well, welcome everybody and thank you for joining me as I try to walk you through the changes of this new law that's called the Consolidated Appropriations Act. So I'm going to change this. This is now the third law that's been signed by the president as a result of the COVID-19. So we're going to discuss, and I'm going to walk you through some of these provisions in this Consolidated Appropriations Act of 2021. It was signed in late December of 2020. So we are going to look at this additional recovery rebate. So the act provided $600 per taxpayer, $1,200 for married filing joint as additional recovery rebate income. Actually, it's not income at all, it's recovery rebates. So this plus the original recovery rebate in the CARES Act will be reconciled in the form of a credit on your 2020 return. Remember those economic stimulus checks that you received for either $600 or $1,200? This one, we're going to be reporting it on the 2020 tax return as a rebate. This act is a little bit more generous than the CARES Act in that they're allowing for $600 for a qualifying dependent. And that the definition of that is someone who is under the age of 17. So married filing joint couple would receive $1,200. The rebate phases out at $75,000 for modified AGI. For a single person, $112,500 for the head of household and $150,000 for married filing jointly taxpayers. The act clarifies that gross income does not include any amount arising from the forgiveness of a Paycheck Protection Program loan, and it also clarifies that PPP funded expenses will be deductible on your tax return. So for the tax extenders, there are a lot of tax extenders. Some were made permanent, some are at 5-year extension mark, 3 years, 2 years, 1 year. If you have anything that you were used to receiving in the past, just please email me your question of what you've received to see where it stands. There's just been too many and it would be really just too detail oriented. We get bogged down in the details if I listed every single one of the extenders. But some of the top ones that I like to highlight are these 5-year, for 5-year extensions now is this work opportunity credit. If some people hire veterans. So this is something that is still in place, and it's been extended now through 2025. The 1-year extensions are going to be this one here for 10% credit for qualified non-business energy property. Another one for the health coverage tax credit and energy efficient homes credit. So that's been extended for another year through 2021. Okay. The extenders. Okay, so this one is interesting. The personal protective equipment and other supplies used for the prevention of COVID-19. It's one of the new additions to eligible expenses to qualify for PPP loan forgiveness. There's been the repayment period of employees' portion of payroll taxes deferred from September 1st, 2020 through December 31st, 2020 has been extended through December 31st of 2021. Very important one to look at if you do payroll. If you have payroll, is this employee retention tax credit. It's been expanded into 2021 with possible 2020 refund potential. It's been extended through June 30th, 2021. For 2020, employers who received a PPP loan may now be eligible retroactively for a 2020 employee retention tax credit. Any wages that are included in payroll costs for purposes of the PPP loan forgiveness does not qualify for this ERC. So what we have to do is for every 2020 PPP borrower, an assessment needs to be made as to whether it would have had ERC eligibility, notwithstanding the PPP restriction, and to analyze the interplay between wages related to the PPP forgiveness versus ERC eligibility. The way we would handle it is the employers will generally use the Form 941X to claim the credit. The IRS guidance was issued on just like last Friday, January 22nd, 2021, and it provides that employers may use a special fourth quarter Form 941. However, this is limited to borrowers who've had their PPP application for forgiveness denied. The IRS points out that these borrowers may forego the special form and simply use the Form 941X to claim the credit. In this time frame through June 30th of 2021, the Consolidated Appropriations Act meaningfully changed the computational rules related to the ERC. As such, businesses that didn't qualify during 2020 may in 2021. If a business qualifies for a 2021 ERC, an opportunity exists to get an advance payment on such credit by filing Form 7200. And the details for going into that are beyond the scope of this. So if you have questions about this, this is an area you ought to email me your questions and we can explore for you. Similar to 2020, 2021 PPP borrowers are restricted from claiming an ERC and the PPP loan forgiveness on the same wages. So this will need to be analyzed. So moving on to payroll tax credits now. These are extended now through extended our refundable payroll tax credits for paid family, sick and family leave through March of 2021. The temporary allowance of the full deduction for business meals. It allows 100% business expense deduction for meals rather than 50%, if you remember that, if the expenses were food or beverages provided by a restaurant. So it's effective for expenses incurred after December 31st, 2020, and it expires at the end of 2022. Another interesting feature is certain charitable contributions deductible by non-itemizers. So the extension and modification of $300 charitable deduction for non-itemizers for 2021 increases the maximum amount that may be deducted to $600 for a married filing joint taxpayer. For 2020, $300 is the maximum that's allowed per tax return, regardless of the filing status. Residents of qualified disaster areas are allowed to take a qualified distribution from a retirement plan or an individual retirement account, an IRA, of up to $100,000 without penalty. Amounts withdrawn are included in the income over the period of 3 years or may be recontributed back to the plan. The Act also increases the allowable amount of a loan to $100,000 if the loan is made due to a qualified disaster and meets other requirements. The 50% limitation on the deductibility of business interest expense under Section 163J was not extended to 2021 by the Appropriations Act, nor was the 5-year NOL carryback. Some of the updates right now are the standard deduction is up in 2021 to $12,550 for single taxpayers, $18,800 for head of household, and $25,100 for married filing jointly. The maximum amount of a deferral in a 401k or 403b plan in 2021 is $19,500 with catch-up contribution limit of $1,000. And for those participants who've reached the age of 50 and over, it's $6,500. Both are unchanged from 2020. The maximum amount of deferral in a simple plan is $13,500 in 2021. It's been unchanged from 2020. The IRA, other than a SEP or a simple, cannot accept more than $6,000 in contributions for any taxable year, not including rollover amounts. Okay, so this one is on automobiles. Everyone is, I've found that a lot of people are interested in this because most employers provide automobiles to their employees. So for automobiles provided by employers to employees that meet certain requirements, the value of this is a change. So I thought it was important to put this into the slide. The value to the employee of the use of the auto may be determined under the cents per mile valuation rule, but only if the fair market value of the auto does not exceed a base value amount. Now, the Treasury changed this. So the Treasury raised the base value from $16,000 to $50,400 in 2020. So they did this so that employers would start to look at this as an option to use. Basically, with the low base value, most people did not want to pursue this at all. For 2020, the cents per mile rate is 57.5 cents per mile for business miles. It's down from 58 cents in 2019. 17 cents per mile driven for medical or moving purposes, down from 20 cents in 2019. And the rate for charitable mileage is still 14 cents per mile and was not indexed for inflation. Looking ahead to 2021, the business cents per mile rate is 56 cents. Still, it's going down. 16 cents per mile for medical and moving, and 14 cents per mile for charitable mileage. So this is another area a lot of people either purchase or they lease their automobiles. So for leased automobiles, there must be a reduction in the deduction allowed to the leasee of the automobile. So the reduction must be equivalent to the limitation on the depreciation deductions imposed on owners of automobiles. And this reduction requires a leasee to include in gross income an inclusion amount determined by applying a formula to the amount provided by a table. This is just something that I just thought we just ought to be aware of when we do tax returns. If you have this, and you're getting your information together, just, point it out that, you're leasing the automobile. So as in the past, there's limitations to allowable depreciation on so-called luxury vehicles. And luxury car caps can be avoided by purchasing cars with unloaded gross curb weights of over 6,000 pounds and trucks or vans with a load capacity over 6,000 pounds. Leasing the car or vehicle also serves to avoid these caps, although there is a minimal add back, the annual income inclusion, that serves to offset the write-off. Section 179 maximum is $1,040,000 in 2020. In looking ahead in 2021, it's increased to $1,050,000. Phasing out for expenditures in excess of $2,590,000 in 2020, and that would be $2,620,000 in 2021. The Section 179 expense limitation on sport utility vehicles indexed to $25,900 in 2020. As we look to the wage base, in 2021, taxable wage base is $142,800, an increase from $137,700 in 2020, with maximum OASDI tax of $8,853.60 from the $8,537.40 in 2020. That's the employer's share. Or if you were self-employed individual, it'd be a total of $17,707.20. The Medicare portion of the tax remains at 1.45%, or a combined 2.9% on all earned income. Workers who make over $200,000 a year will have an additional 0.9% in Medicare taxes withheld. This is another so-called perk or nice part of this Appropriations Act. The repeal of the maximum age for traditional IRA contributions effective for contributions for tax years beginning after December 31st, 2019. The first post 70 and a half, that's the person's age, contribution to a traditional IRA can be made for 2020 between January 1st, 2020 and April 15th of 2021. Okay, but do be aware that this comes at a cost if you're making a qualified charitable distribution. And if you are, just give me a call. Here's another good one. Required minimum distribution age requirements. So the RMD was waived for 2020, but it's required in 2021. The age requirement for required minimum distributions has been changed from 70 and a half years to 72 years old. The required beginning date from IRA minimum distributions is April 1st, following the calendar year of the IRA holder's 72nd birthday, provided that the individual turned 70 and a half after December 31st, 2019. And that's a tongue twister, but if you can just think it through, just, you know, it's pretty simple in calculating the age. And I think that's really nice and important what Congress has done. In addition, there's been an expansion of Section 529 plans to include expenses associated with registered apprenticeship programs. So in addition, up to $10,000 of the lifetime maximum may be withdrawn to pay student loan principal amounts and related interest expenses for the beneficiary or beneficiary siblings. Another update is there's no 10% penalty on early distributions of up to $5,000 from IRAs and retirement plans for births or adoptions. Non-spouse beneficiaries of inherited IRAs and qualified plans generally must now withdraw over a 10-year period. So there's been change in the kiddie tax. Children are taxed on the unearned income at their parents' highest marginal rate, not the trust or the estate's rate. That's pretty decent. So, this is something that's taking us to look at the future. I don't know if anybody has ever dealt with the virtual currency update or virtual currency at all. There's a whole different number of them that are out there, and it's caught the eye of the IRS. And so I just thought it would be very important just to keep an eye on it, see what is going on. It's been so important that the IRS has decided to move this question, if you've ever dealt with virtual currency, to the first page of the 1040. And you're going to be required to disclose whether you've received, sold, sent, exchanged, or otherwise acquired any financial interest in virtual currency. So the IRS has, I think it will develop an overall strategy, and it already has set some strategy in place to address the taxpayer use of virtual currencies as property and as currency. The IRS will actively follow up on information received under the Coinbase John Doe summons, estimated to apply to more than 10,000 taxpayers. So it is something that's relevant. The new placement at the beginning of the Form 1040 under the name and address fields indicates the IRS has an increased focus on this cryptocurrency activity. FinCEN is considering requiring the FBAR for cryptocurrency. Something that is new is the form. It's not really that new. I believe that it was out in the 1980s, but they brought it back. So we're going to see this year a new form 1099-NEC. It's the non-employee compensation. So you file this 1099 NEC non-employee compensation on or before February 1st of 2021 using either paper or electronic filing procedures. And you file form 1099 miscellaneous by March 1st, 2021 if you're paper filing, or by March 31st, 2021 if you're filing electronically. So that pretty much concludes the presentation. I thank you for your attention, and I'm free to entertain questions.
Yeah, one of the things that I wanted to bring up is that anytime that there are new tax law changes, oftentimes what happens is that people have very specific individual questions. Now, there might be some of those questions that are so individual and so specific that Linda might have to get back to you, but we also have a couple other accountants on this call today too, who can chime in and help. So, tell us a little bit about yourself, why you came to this meeting, what you were looking to learn, and do you have some specific questions right now that we have some time to field and answer? You can answer them in the chat, or you can turn your mic on and just ask through that.
Is somebody talking?
No, I can't tell.
No. I think a lot of people are also interested in the PPP loan forgiveness, and I think that's something that can be addressed, individually outside of this.
Yeah, I think that there's just a lot of apprehension because it hasn't been one. Like people have had multiple rounds for PPP funding. They want to understand how their business is affected, and then when they're thinking about PPP funding, they're also thinking about when should I apply this, and things like that. So I definitely think that a lot of this, it really goes back to the fact that this is why you need to have a tax professional be able to sit with you and work with you through things. We have these seminars to give people kind of a taste of all of the new material, new laws, new changes, but ultimately it comes down to your specific situation, and these small choices can actually have massive tax impacts on your overall financial from a business end and from a personal end.
In addition, Matt, I'd like to say that establishing business relationships with bankers is really critical at this time, because I've come across a lot of clients who have a need for loan applications, or they're the ones that are small. Their income, their gross revenue is not that large, so they're looking for a banker to establish a personal working relationship with. the clients that I'm working with and hearing from, they don't want automation. They want the person to know who they are and to be available to them. So like, I really, hope that, the bankers can give me their contact information so that I can forward it to some of the clients that I know of that are interested in the loan or other areas of their business. There are a lot of business owners that we deal with here at Donnelly-Boland Tax Services, and the clients here really prefer a personal relationship, one of trust and effort.
Absolutely.
Yeah, Linda, this is Clay. I'm with Brentwood Bank.
Hi.
Hi. And
Nice.
that's a very kind offer that you just made. And in fact, Brentwood Bank, we very much value the relationships we have with whether our retail customer or our business customers. So if Anna wants to share my email with you, or I can forward it to you directly. And if it's whether it be a commercial lending need, a personal need, general business services, yes, no, we very much value the one-on-one relationship. Thank you for reaching out.
Yeah, and that's one of the things too. We have to understand that, different people have a different role to play in all of these things. And ultimately for our community, we're trying to do the best for everybody. Make sure that as many people as possible are benefiting and are finding the resources that are available to them. Sometimes those resources might come in PPP funding or things from small business groups. But it's not just enough to get the money. You also need to know what to do with the money when you have it. You need to know how to get the money forgiven. You need to know how to track the money appropriately, what year to put things on in your taxes. And then even just from an individual perspective, there are a lot of times where people don't understand tax implications that could vastly change how much their take home is. And if you don't understand the tax laws, if you aren't continuing to stay up to date on these new laws and changes, ultimately what happens is you lose out. If you don't know the rules that are available to you, you end up you have blinders up everywhere. So that's really what we were going for today, to make sure that you understand a lot of the new rules and regulations, and when you don't know, you know who to reach out to.
Great. That's really good. A good point.
Anna, would you like to wrap up?
Good. So, thank you guys, everybody that came out today. I know that we had a lot of information to digest, and repeating what Matt said, sometimes it really does come down to very individualized questions. So what you can all expect is I will be sending out an email after the seminar today that has a survey on it, and it will also have a link for the video if you want to watch this presentation back, and it will have Linda's contact information. So, everybody that would like to get in contact with Linda, you'll be able to, and if you have some questions or you'd like to give her a call, you'll be able to do that as well. So I think we made good on time today, and we covered a lot. So I appreciate everybody taking some time out of their busy mornings to come by, and I hope everybody has a great rest of their day.
Thank you. Same here.
Yeah.
Have a good day.
Thank you. Stay safe.
Thank you. Bye.
Take care. Bye.